Hi, everyone. This is Delilah Rothenberg, the Executive Director of the Pre-Distribution Initiative. Thanks so much for joining us today. This webinar is going to be audio only, so you are not missing anything if you just see one slide on your screen and not us. For those of you who aren't familiar with the Pre-Distribution Initiative, as we're hosting this webinar today, we are a multi-stakeholder project designed to co-create improved investment structures and practices that share more wealth and influence with workers and communities, that have stronger incentives for investment teams to integrate ESG, and that ultimately address systemic and systematic risks, including inequality and climate change, to name a few. This is our third webinar in a series following our paper, ESG 2.0, Investor Risks Beyond the Enterprise Level. And that paper is really about risks that we need to measure and manage at the investment and market structure levels, not just at the portfolio company operations level. So if you haven't checked it out, we'll put a link to it in the chat, and please do take a browse through it. The paper covers a number of different topics and brings them together in a central argument. But because the paper covers so much, we are doing this webinar series that does a deep dive into the various topics in the paper. So in this webinar, we are very pleased to feature the highly renowned economist Karen Petro on her book, Engine of Inequality, The Fed and the Future of Wealth in America. And Karen will be in conversation with our chief economist at the Pre-Distribution Initiative, Raphael Schaap. Karen's work is particularly relevant to us given investors' migration up the risk-return spectrum for yield, particularly in a low interest rate environment and with quantitative easing. For those of you who have read our paper, and for those of you who haven't read it, just to update you, it focuses on how this migration can lead to some unintended negative consequences for numerous stakeholders, including investors and workers and communities and even the environment. And in this webinar, we hope to unpack the details about how these dynamics play out and what investors can do about them. So a few housekeeping items before we jump into the main session. The chat function should be enabled. So although this is a webinar, you should still be able to interact with one another through the chat. There's also a Q&A function, and when you put a question into that function, different participants should have the opportunity to upvote and to prioritize the questions that they are most interested in hearing about. But hopefully we'll cover all questions. We're going to try to allocate 15 to 20 minutes at the end for an audience Q&A after Raphael and Karen's discussion. And the webinar will be for 1 hour. So with that, I'd like to introduce Raphael Schaap. She is our chief economist and a founding member of the Pre-Distribution Initiative. She's also an assistant professor of economics at Drew University. And outside of her work at the Pre-Distribution Initiative, Raphael's research focuses on monetary policy and the theory of money and banking, as well as volatility and economic risk for households and companies. And in a prior life, Raphael also worked as a tax attorney on Wall Street. So Raphael, with that, I will hand it over to you. And Karen, thank you so much for joining us, and really looking forward to this conversation.
Thank you so much, Delilah. I'm going to introduce Karen. Karen has a very impressive bio. She is the managing partner of Federal Financial Analytics, the financial services consulting firm that she co-founded in 1985. She is one of the most sought after financial consultants in Washington, D.C. Her views are featured in the Financial Times, in the Wall Street Journal, in American Banker, NPR, CNBC, many others. She has also testified before Congress and spoken before the Federal Reserve Banks, New York, St. Louis, San Francisco, Chicago. American Banker has called her the sharpest mind analyzing banking policy today. She has just published a book, Engine of Inequality, published by Wiley. You can all see the cover. And I'm going to give maybe, as a way of introduction, a high-level summary of the argument in the book. The Federal Reserve, the Fed, has been touting recovery. But before COVID hit, recovery from the financial crisis in 2008. But before COVID hit, we, even though we supposedly had very low unemployment in the US, we were a lot more precarious than the Fed would have had us believe. So Karen, you describe in your book the increase in inequality and the hollowing out of the middle class, and this is very well documented in the economics literature, so I'm not going to recap all the statistics here, but just to say one number here, just before the pandemic, the Fed did a survey on households and their ability to handle financial stress, and a large percentage of those surveyed, 37%, could not withstand a $400 unexpected expense. So Karen's research in the book exposes a clear causal relationship between monetary and regulatory policy and inequality. The book argues that the Fed's policies have had a range of perverse, unexpected, unintended effects. They have fueled inequality, as well as other dangerous trends, such as moral hazard in financial markets, systemic risk, and a debt trap. Karen, you argue that what the Fed has been doing is stabilize money markets, but it's doing this at the expense of the rest of the nation. And yet not many people, or not enough people, are aware of these trends, and this is why we're here. In your book, you invite us to understand the impact of monetary policy by following the money and not the model. That is, looking at what markets and investors are telling us. Today, our audience consists primarily of investors and asset allocators, and of particular interest to them are issues around portfolio construction in a low interest rate environment, how to avoid contributing to high levels of systemic risk, how to address the issues you unpack in the book, including inequality, and how to plan ahead if the Fed adopts some of your suggested policy fixes or if it doesn't. So let's start with what the Fed has been doing, the Fed backstop. The first question for you is, starting in 2008, and of course, more recently as a response to the pandemic, the Fed has policies, some of which you suggest are actually out of its mandate. Leaving aside all the negative consequences for now, which we'll come back to in a minute, can you walk us through what these interventions have been, why they're so enormous and unconventional, and what they were intended to do that was positive?
Certainly, and thank you, Raphael, for that great introduction and terrific summary of my book and how I hope it fits into the interests of everyone on this webinar today. In Engine of Inequality, the subtitle is The Fed and the Future of Wealth in America, because the point I am trying to make in the book is that monetary and regulatory policy, I'm thinking of them both together because they have interactions, and so I call that financial policy, have had profound impact on income and wealth inequality in the United States since at least 2010, even though they are unrecognized by most as a cause of economic inequality. In the book, I talk about how there are, of course, many other causes of economic inequality, and I'm not in any way suggesting financial policy is the only one or even the most important one. I think all of us looking at these issues as citizens as well as financial folks, we all know that tax policy has a tremendous impact, fiscal policy, such as we've seen in the last few months from the Biden administration, demographics, education policy, trade policy, technology. All of these important social and economic trends have had significant inequality impact, but many of them are well outside the policy framework. And financial policy, monetary and regulatory, is not. It is the act, if not of God, certainly of a rather august institution, the Fed. And the point of my book is to show those unintended effects, and because they can be quickly changed without even much new law, if any, to try to urge the Federal Reserve to make those changes. And I hope as we go through this discussion, we can talk about not just the problem, but also some of the solutions. The publisher wouldn't let me, editor wouldn't let me finish the book without putting in two chapters on solutions, and they were the hardest part to write, so I'll look forward to talking about them too.
Thank you for this. So what is it that the Fed is doing that has been so unconventional, that has fueled inequality?
I think there are four aspects of monetary policy, the last of which intersects with regulatory policy, and there too there are some unintended but very profound inequality impact. And I'd be happy to tick them off. The first are ultra-low interest rates. The Fed's theory, which everybody talks about current policy as unconventional, but this is in fact quite conventional thinking, which is that if you have low interest rates, you spur economic growth, which enhances employment, and obviously that all would be good for economic equality. But it didn't happen. I think I can explain why, but most importantly, many central bankers, all of us who took economics, that's the way it's supposed to work, but it didn't. From 2010 through 2020, when COVID hit, we had ultra-low interest rates and the weakest recovery in post-war history in the United States. It didn't work. And in my book, I say, I think the reason is that all of us who learned those theories, myself, I'm old, and so I learned them with a lot of the senior people at the Fed at about the same time. We learned economics, and most theory still reflects the fact that the United States was an equal nation. We had a robust middle class, so that when rates went down, families had the discretionary income from which to make new purchases, or they had the savings with which to say, you know, rates are down, now we can afford a house. And that did spur demand, which generated growth, which generated sustained employment. Now, however, as I show in the book, the majority of Americans through up to the top 80%, all of the top, but the top 20%, have more debt than assets. And a remarkably large number of households, even those with significantly above median incomes, are living paycheck to paycheck. We had an early warning of this in 2018 when the federal government shut down, and federal government employees who make on average $85,000 a year missed two paychecks. And by the end of the government shutdown, 62% of them were unable to make rent or mortgage payments. People, again, are living paycheck to paycheck. And the cost of the debt that most households have taken out is not in any way responsive to ultra-low interest rates. Everybody on this call, we know what our credit card bills are. We don't typically go to payday lenders, I would guess, or some of the less reputable forms of auto finance. But the lower down the income spectrum and wealth spectrum you go, the higher the cost of obtaining financial services, including assets. So you don't have responsiveness to ultra-low rates in growth. What you have instead is yield chasing, as you said, Raphael, and market profits, significant, if not significant asset valuation increases. And of course, again, if you look to see what happened, that's what happens with perhaps the most clear indication of that, I think, after COVID hit, when the Fed reduced rates and increased its portfolio, which I'll get to in a minute, and markets were so responsive to the Fed that even though literally the day COVID death rates hit their highest point in April, the market reached S&P record increases in terms of growth that hadn't been seen in 30 years. There's a huge dissociation between what interest rates do for the economy and what they've been doing for the markets, and that's, of course, quite risky as well as unequalizing. The second thing the Fed did that was genuinely unconventional, nobody had ever done this before. The Fed had thought about holding a big portfolio and laid some legislative statutory pipe for it, but it had never done it until 2008 when, as you all know, the Fed began quantitative easing. At its height before 2020, the Fed's portfolio hit about $4.5 trillion. As we speak, it's pushing over $8 trillion, and it may hit 10 before the year is out. That is a huge amount of money. And it, of course, again, distorts markets. And it doesn't spur lending. The whole theory of quantitative easing was that it was going to give banks the money and the financial system were generally the money with which to spur growth. And from the bank's perspective, most of the money that they've received from the Fed in terms of in return for asset purchases is cycled right back into the Fed and is being held at in excess reserves on the Fed's own balance sheet. Their liabilities, they don't count to the $10 trillion asset number, but the money just goes right back. The banks aren't lending it out. The banks are holding much of it at the Fed, or they are chasing yields also with high risk, high yield lending, particularly in areas like the leveraged loan market. Part of the reason for that is the interplay between ultra-low rates, quantitative easing, and post-crisis regulatory policy. Raphael, you mentioned that one of the things I say in my book is you have to understand what's going on. You have to follow the market, not the model. And the Fed has, along with the other banking agencies, has significantly changed the rules governing the banks since 2010. And of course, the banks deserve this. There was a lot of high risk in the system, and nothing in my book argues for reducing the post-crisis regulatory framework. But you have to recognize what it does. The banks don't just say, okie dokie, I'll just make a little bit less money on that loan. Particularly when you have ultra-low rates and very high regulatory capital costs, banks change their business model. And they have done so dramatically since 2010 by moving out of financial intermediation, taking deposits and making loans across the spectrum of consumer and corporate needs, to serving sectors of the market and relying more and more on fee income. Many banks are now essentially what I call wealth management machines. They're not financial intermediators. Even before the business model changes had taken full shape, the Bank for International Settlements looked in 2018 at what quantitative easing had done after the great financial crisis. And it determined that while QE in 2008 and 2009 did have a significant output impact, its only impact as of 2017 was a persistent and significant impact on equity prices. In other words, the Fed's huge portfolio was, like ultra-low rates, good for the markets and nobody else. So I think those are the two of the unconventional actions the Fed has taken. And the third is closely intertwined with them because it has taken the actions, ultra-low rates and quantitative easing, because it believes markets are the engine of growth, that investments will fuel into the stock market, and in stocks will somehow spur companies to say, "Oh, look, let's go build a plant. Let's use and the market is instead recycling the money because there is no genuine sustained demand for the kinds of loans that would support shared prosperity." The higher the markets go, the more risk it poses, and therefore the Fed has really come to take on a third role, one only somewhat linked to its charter. The Fed is responsible, under a broad reading of its law, to ensure financial stability, and it's certainly a good thing that it does so. But it shouldn't be providing the ironclad safety net beneath the market. In 2013, when the Fed, Bernanke just mentioned the thought that the Fed might begin to normalize its portfolio, as the Fed had always intended, the markets reacted, not extremely, not significantly, not dangerously, but there was a modest correction, the so-called taper tantrum. It scared the Fed. The Fed backed off. And it never reduced its portfolio. It just began in 2018 to allow some of it to run off. It got spooked. And of course, markets continued their ever upward climb. In 2018, the economy began to show some significant growth. Inflation was beginning to pick up a little bit. The Fed thought maybe it was time to do the second thing it had always planned to do, which was normalize rates up from 25 and 50 basis points, which are, of course, negative after taking even a tiny bit of inflation into account. Rates went up a little bit. The market didn't like it. Again, it wasn't a dangerous correction. It was a recognition that yield chasing might no longer prevail, risk premia would start to normalize, and the Fed backed off, and it turned around the next month and lowered rates again. And of course, the markets then continued to operate with the expectation that anything big was too big to fail. The Fed's repo market rescue in 2019 further reinforced that perception. And of course, in 2020, COVID is an unprecedented shock, but the Fed stepped in, bailed the market out, even down to the level of junk bonds and ETFs and other instruments that no one ever thought had a safety net spread between them. And I think that's a very dangerous trend for looking forward, particularly given how high equity markets have risen since then.
So the rock bottom interest rates, the quantitative easing, and the safety net. Just to throw some numbers in there, you write in the book that the Fed's portfolio rose to about half of the US total economic output before the crash. So that really gives the scale of the intervention. You write that there's significant moral hazard and risk as a result of this. And I just wanted to ask you really quickly, can you explain a little bit why this is actually bad for markets?
I think it's bad for any of us to think actions have no consequences, because we all, and markets are individuals, each of us. Now, if the only good you wanted is ever rising markets, and you don't care how much public wealth is invested in the market, I mean, where does the Fed money come from? For example, the money it prints to support its portfolio. Now, it obviously comes out of the air in the sense that the Fed is the monetary policy authority, but it alters the way wealth is allocated across the country. And instead of using federal resources for public wealth, education, infrastructure, all sorts of things, we have a huge amount of money supply being created to propel markets. And I think that's also unprecedented and often, sadly, unrecognized.
Right, and there's almost a vicious cycle in which the interventions keep getting bigger and the risk increases. The markets seem to become even more reliant on future bailouts. Would you say there's almost a dependency of markets now on Fed intervention?
I think not almost. I call it in the book, you know, we all know about the doom loop, and we learned that phrase in 2008 and especially in 2011 with the European debt crisis and its metastasis. With the idea, of course, was the doom loop was between sovereign borrowers who weren't attuned to market risk. They were engaged, of course, in moral hazard, whether it was Greece or Italy or Portugal or whomever, and they just issued lots of debt to sustain political goals. Who bought all that all that debt? Giant banks, of course. So as soon as it became clear that a country might not, in fact, have the capacity to honor its debt, banking started to wobble, and you quickly saw in 2011 the doom loop between sovereign borrowers and giant banks, most of which were in the European Union in particular, far too big to fail because of their macroeconomic impact and financial system dependency. Well, I think we have a new doom loop now, and it's the one between ultra accommodative monetary policy and financial markets, because even a little indication, again, the Fed wants to normalize. I mean, what I'm calling on the Fed to do in terms of normalizing rates and its portfolio is what the Fed wants. The Fed, however, is handcuffed essentially to markets that have now grown so unstable by virtue of the dissociation between asset prices and actual return that it's afraid to do anything. And just keeps continuing to power the market.
I think we'll come back to that. That's a really interesting point. I wanted to ask you the link with inequality, the so-called wealth effect, as a result of the Fed focusing on markets and not on households. So you point out to some numbers here about how US and wealth inequality grew worse after the Fed intervention in 2008. The wealth of the top 10% grew by 19%, but the lower income families lost 16% of their pre-existing wealth. And you suggest that this is because these interventions have dramatically increased the wealth of those who own stock, but stock ownership is highly unequal, right? The top 1% owns more than half of US equities, top 10% own 86%. So the Fed backstop led to a major transfer of wealth. So you're actually calling this out as a wealth transfer. And so the question for you is, how exactly does this wealth transfer work? Where does the money come from? Who is it going to? Can you elaborate a little bit on that?
Well, I think it gets complicated because the transfer is the result, I think, of a hollowed out middle class. And so there is not that center in the middle which has the discretionary income or the financial stability to invest in the markets. Sure, people have 401ks, but that's still a small percentage of the population. And as you rightly said, Raphael, if you look at actually how much stock most Americans have, it's if they have any, they're in the middle to upper middle class as well as much wealthier. And anyone but the top 10% has very little financial equity and much more debt. So it is not so much a handing over of resources as it is the fact that it is increasingly impossible for lower wealth households, for example, to save. I think the Fed's whole theory of ultra low rates, as I mentioned before, is that they will generate demand that then spurs employment. Well, as I tried to show a minute ago, that didn't. I think it's demonstrable that it didn't happen, and I think I tried to show why, because of economic inequality. The other thing that ultra low rates do is they make it impossible for Americans to save for a down payment, for education, for a rainy day fund. As you said, 40% of Americans, because the number's up a little bit of late, 40% of Americans couldn't handle a tire blowout without taking on more debt, and 15% or so of Americans can't handle it at all, even because they have no more, they're unable to get more debt. So how do you have economic security, the kind that permits intergenerational mobility and wealth accumulation, if you are never able to save for retirement or a home or an education?
Right, and your savings are also not generating any returns because of the low interest rates. I think you cite one study, there's a loss of 2.4 trillion in savings from 2008 through mid 2017, just because the returns aren't there.
Well, yeah, I mean, look, I've said this before, anybody who saves is a loser. Anybody who invests has been a huge winner. I mean, that's just been the case since 2010.
So in your book and also in our paper, we both talk about secular stagnation. So the implication of this for growth. Can you elaborate a little bit on what secular stagnation is, and can you talk about the dynamics between investors and policymakers that actually contribute to secular stagnation?
I'm not, although Delilah kindly said I'm an economist, I'm actually not. My academic training is in political economics, and my long background has been in financial policy, monetary and regulatory policy. So I will think you would do a far better job than I describing secular stagnation. Your paper certainly does a terrific job of that. But I think it's part of the reason, why is the United States moving so slowly in terms of even GDP growth? It's a terrible measure of prosperity, by the way, but even there, that preferred measure of growth is highly inequitable. Even if we didn't have secular stagnation and had growth, it would not be equalizing because, as we discussed before, productivity isn't shared. It's a very interesting study that we posted. We have an economic equality blog and posted an analysis of that on the blog because it came out later than the book. But it showed that in 1975, course, the United States had people who made more or less money, and from 0 to 100 income spectrum, but GDP was equally shared. If you earned $10, you got $10 worth of GDP. If you earned $100, you got $100 worth of GDP. It's a dollar for dollar return for your hard work. In 2018, all the top 1% earned 312% more than its 1975 equitable share of output. And the bottom 50% worked harder than their return in GDP. Something's really gone wrong, and I think, again, it is the fact that the Fed, in part, has been counting on the, quote, wealth effect to trickle down productivity and output, and therefore wealth, to lower income, middle class and lower income households, and it isn't. I mean, you can see on every statistic you look at, it isn't.
Yeah, in the book you mentioned that the Fed thought that households would respond to lower interest rates just by buying more stuff, but the U.S. household consumption relies on low and middle income households already spending all of their income, and they're already highly indebted. So there's no additional real capacity to borrow, right? So that doesn't stimulate the economy. Is that, do you agree with that? Yeah.
Yeah, no, you're quoting my book precisely. I mean, the whole theory of ultra-accommodative rates is based on the old view of what's called marginal propensity to consume, which, again, is based on discretionary income, i.e., if it costs me less to borrow, I will go out and buy something. Well, the more inequitable a society gets, I mean, I don't need another house. I've got enough house. I don't need more cars. I have enough cars. What do I go out and do? I go out and have a more expensive restaurant meal, but does that support productivity? I mean, service employment is important, but it is not a restaurant workers are not in a get-rich-quick business. And the marginal propensity to consume, the act of consumption, is all the marginal ability to propensity is at the upper class, upper wealth and income groups. The actual consumption takes place hugely in low, moderate, and middle income households with no excess capacity because they're already so deeply in debt.
So inequality is also a systemic risk. And you have this great sentence in the book: the faster inequality increases, the harder it is for drivers to control its destructive force. And so you have a really lovely quote by Aristotle on political risk, the dangers of losing a middle class, and the warning about the extremes becoming more dominant. And so that's one issue. We can also think about the health crisis, the opioid epidemic, political polarization, et cetera. And all of these would be of concern to ESG investors. But I want to focus for 1 second on financial crisis risk. You point to many studies in the book that show a causal link, so not just correlation, between inequality and financial crises. Can you briefly explain to us how inequality creates systemic risk and how it's connected to these dynamics of secular stagnation?
Well, I think it's intuitively, I think there are two different issues: financial crisis risk and secular stagnation, because one is an explosion and the other one is a prolonged malaise. So from financial crisis risk perspective, it's actually intuitively, I think, obvious. When the larger percentage of a population you have that is economically fragile, for the reasons we've just discussed in the United States, no rainy day savings, no marginal propensity to consume, high household leverage, the more it is that even something that would otherwise be resolvable becomes instantly catastrophic. There is no resilience built into the macroeconomy when the majority of households are economically fragile. And I think we saw that in 2020. And it wasn't just that COVID was such an unexpected shock. In the book, you can see I had to do an awful lot of rewriting of the book because I had said in the manuscript, oh, this might happen or that might happen. And then the book was due to the publishers in the end of June. And, of course, all of a sudden, COVID and the markets hit. And I looked at it, and you can see in chapter 8, particularly in the book, how high household leverage was. And when unemployment hit, you had a huge macroeconomic disruption that immediately, of course, hit the financial market. We would have had a crisis. There's no question. You cannot shut down an economy as we did in a day, literally. But did it have to ripple through the financial markets? There were markets that were increasingly no longer dependent on regulated banks with large capital and liquidity reserves. As I said, I'm not calling for reducing bank resilience, but instead on money market funds, open-end mutual funds, and many other financial instruments that were incredibly exposed to liquidity and then to solvency risk. They were all yield chasing, and they did not have the liquidity even to sustain a day or two of unexpected redemptions.
Right. So what you've described already, this shift in the business model of banks, right? And how the banks, when the rates are ultra low, they don't make loans, they shift to asset managements. You actually point to a Bank of International Settlement study that banks have shifted from lending to these fee-based businesses, and whatever lending they do, it's to riskier loans. And because of the regulatory overall and post 2008 and the stricter capital requirements, the banks can hold on to that risk. So they've transferred it to the shadow banking sector. Shadow banking being non-bank financial intermediaries that provide credit outside of normal banking regulation. And they can acquire these from banks, but often directly originate loans themselves. What we can contribute here perhaps to this discussion is the perspective of the shadow banking sector. We might have many on the call, which is that in order to earn these required rates of return, they've turned to high risk assets, yield chasing, already described this. So they've migrated up the risk curve. So the same reasons that is really driving this shift in the banking business model is also the same reason for this yield chasing. It's this low interest rate and regulatory environment. So do you see a lot of systemic risk build up as a result of the way that investors in the shadow banking sector constructing their portfolios? And do you expect a market correction as a likely outcome?
Well, I do, and I'm not accusing money market funds, shadow banks of being evil. The shadow term suggests the dark, stealthy. No, it's just, again, you follow the market, not the model. And each entity in the financial system, whether it's the low, moderate, or middle-income household, whether it's the bank, whether it's the money market fund or open-end mutual fund, each of us follows our economic incentives based on the capacity we have to achieve them. And particularly entities with fiduciary obligations, pension funds, life insurance companies, plan administrators, the vise the Fed has put them in by the combination of ultra low rates and quantitative easing combined with the safety net beneath the market has to encourage the behavior that we've seen and the risk that it engenders, the risk we saw in March of 2020. Now, I think the near-term impact of that, and this is my day job, I should tell everyone, I wrote this book, nights and weekends. This is nothing to do with my day job, which is advising major financial services companies on regulation and monetary policy. So I spend a lot of time also working through not what should be done, but what to do not what should be done from a policy perspective, but what to do in terms of market success, because that's my day job. And I think you will see significant new rules. This was threatened in 2013. I know the Financial Stability Oversight Council hopes this time the SEC will, and Gary Gensler intends to institute much more significant, whether it's capital buffers or minimum balance at risk or similar types of requirements for the fund sector. That's the near-term effort to try to forestall another round of systemic risk.
So let's talk about your suggested fixes. I want to leave enough time for Q&A, so I want to talk about this. You described that the reason for the Fed's misguided optimism is myopia, that the tools that the Fed is using to measure unemployment, wage growth, inflation, etc., are obsolete, and the primary issue has to do with using aggregate data, averages, which hides the distribution. This is really interesting. So a question for you, if these tools are flawed because the Fed is neglecting all these distributional elements, and you encourage the Fed to see America as it is, so the Fed is not really seeing the world as it is, and markets are getting used to measuring prices by the Fed policy, not by the underlying growth or profitability. So if the Fed is using flawed tools, should investors be worried that it doesn't really know what it's doing? And is that a concern if the Fed is such an important driver of prices?
Well, I think so. I mean, it's pretty obvious. The Fed is making this stuff up. It has, and I won't, again, I don't know how many of you are spending time understanding the role of interest on excess reserves or the overnight reverse repo facility or the standby repo facility that cropped up again in the most recent set of FOMC minutes, because the Fed knows its monetary policy isn't working. That's why it launched a huge inquiry in 2017 and in 2019 announced this new, quote, hot policy, which now allows inflation to exceed 2% for some period of time to some extent. The Fed has never made clear what that means, with ultra low rates retained until 2023 or 24, but maybe sooner if data suggests something different. The Fed is just making this stuff up. And one of the reasons it is constantly surprised is because it is mismeasuring mismeasuring unemployment, it's mismeasuring inflation. I just wrote a memo on Friday about the importance to look at inflation as purchasing power, not the indices on which the Fed prefers. And it's mismeasuring growth. And those are pretty big things to mismeasure. Among other things, mismeasured wealth and income as well.
Right. So other policies, fixes that you suggest, the Fed should engage in controlled increase in interest rates and reduce its portfolio and balance sheet. Can you briefly walk us through like how you envision this would work? You have a timeline in mind, or?
No, I don't, because I think the facts on the ground are going to determine that. You have to factor in things. I can't. When I wrote the book, I couldn't predict the election outcome. I can't predict fiscal policy outcome, and I think it's very important. I mentioned before the importance of thinking about monetary and regulatory policy as interactive. Well, monetary, regulatory policy, financial policy also has strong interactions with fiscal policy, particularly the impact all the stimulus we've seen and that the Biden administration is seeking Congress to approve. That changes the outlook. So my goal is more to set 30 to 100,000 foot level objectives and determinations. One is that interest rates should be normalized. I have spent a lot of time, what is the neutral rate? What is it? I think you need to think about a living return. What is the rate above inflation that would permit households to save for retirement or nearer term goals, and that would reduce yield chasing incentives in the market? What is the risk premium we need there? And the Fed should be aiming for that rate, which is the genuinely neutral rate, not the construct, the R-star construct it prefers to play around with. I think the same thing is true on a portfolio. I think their portfolio reduction can move much more quickly than rate normalization, because the Fed's portfolio is already so huge. But I don't have a dollar total, how many trillions a month, that sort of thing, because I think it's dangerous to try to forecast in a vacuum.
And if conventional monetary policy applies, increasing the rates would hurt growth, but actually you say we're no longer in a world of conventional monetary policy, right? So this doesn't have to be the case.
I don't think, as I said, it hasn't. I mean, you look over in the last decade plus, ultra low rates have not increased growth. The Fed's view that the economy was in a, quote, good place starting in 2015 due to ultra low rates and its quantitative easing policies is belied by any statistic about the economy in which you take distributional realities into account. If you look at medians, not averages, or understand the components of income. For example, you can look at household income the way the Fed does and say, oh, look, household income is up. Isn't that great? Look what we did. It's a good place. Or you can understand that household income was up because more families had more wage earners because they couldn't afford consumption without at least two wage earners in a family. And many of those wage earners work two or even more jobs and more hours. Now, that's not genuine increase in household income. You have to look behind the aggregate data and understand what's going on.
So one last question as a way to conclude, because we want to take the questions that are popping up in the chat.
Sure.
The link between ESG investing and monetary policy is not obvious, right? But as a way to conclude, what we're thinking about at the Pre-Distribution Initiative is what investors and other stakeholders should be doing right now to reduce risk and prepare themselves for perhaps when interest rates rise. We're exploring ways in which investors should be perhaps reevaluating their portfolios so that there's not so much risk. So things like adjusting the portfolios to put more in the middle of the risk spectrum. Do you have thoughts on this? Do you think investors can play a role in terms of reducing things like inequality and leverage independently of what the Fed does? My thinking on it as I'm listening to you is perhaps if investors take the lead on investing differently, we could have a more robust economy, which could make it easier to increase the rates. I'm curious for your thoughts.
I think it's very hard for investors to invest differently when they have fiduciary obligations or market demands. Obviously, you know, the question of what do you do for whom has to be answered in terms of what is your fiduciary obligation, as well as what is your moral imperative. And I think markets, in a sense, need to be bloodthirsty, and ESG investors have to look for yield. They're looking for yield in genuinely good places, but otherwise it's philanthropy. And that's where moral imperatives come into play. It's a very tricky area. What I would hope is that everyone on this call can see that the ESG investing has taken on not just greater importance, but also the kind of additional risks you and your study highlights, not because you're all just a bunch of cowboys and cowgirls, but because the current policy framework makes it impossible to achieve social obligations at acceptable risk-return ratios. It's very hard to do. You have to chase yield.
So the Fed could potentially be undermining these fiduciary obligations.
The Fed is not potentially. It is very hard to make a reasonable rate of return without taking significant risk. I mean, that I think is just a full, flat-out statement.
Delilah, do you want to jump in?
Sure. Well, this is a really great conversation. We have about 9 minutes left and a few questions that came up in the chat. I do think that one important point worth noting is that in our paper, we do go over some new emerging investment structures in the middle of the risk return spectrum that could help institutional investors meet their required rates of return and fulfill their fiduciary duties if they allocate more to the middle of the risk return spectrum, as opposed to barbelling the approach with high allocations to low risk return and high risk return strategies. And so in our future webinars, we will be talking about these new and emerging investment structures and different ways to allocate capital so that we don't end up overexposed to this high end of the risk return spectrum, and potentially find some new solutions that are coming out in this emerging paradigm. With that, I do want to, I'm going to read through the questions that came up, and Karen, feel free to answer all of them or some of them, but I think it's sort of a fire round.
Okay, I'll go fast.
Okay, so from Scott Kalb, Karen, are you critical of the central bank for lowering interest rates in the aftermath of the global financial crisis and the pandemic, or are you critical of the fact that they haven't acted fast enough to normalize rates again? What should the central bank have done in response to the crisis? And he has another question too.
Okay, well, let me just answer that one to be clear. I am critical of the failure to normalize as conditions normalize, not of the immediate emergency action. And I think that rates would have been easier to normalize, particularly after 2020, if they hadn't already been so low. It's a downward cycle. You know, the Fed has less ability to normalize because everything is already so abnormal.
Okay, great. That was a good quick answer. His next question is, well, maybe actually I should, Scott, I'm going to come back to your second question to make sure I at least get to read out two other people's questions, to be fair for everybody. So this is from Sean Thackerdine, and he feels his question is naive, but perhaps it isn't. Is the bank sector trend towards fee-based service away from financial intermediation itself a recognition of the fragility of households' financial security?
Oh, it's not a naive question at all. I think in actually chapter 9 of my book really takes a hard look at this evolution of banking into e-delivery, as well as the question of digital currency, central bank digital currency, and the role of the tech platform companies, whether it's Facebook's effort to create its own digital currency called Libra, now Diem, or others. I think it's really important to look at the transformation of the financial sector, not just from a risk perspective, but also from the equality one I try to adopt in the book. And I think the reason for the sharp shift in finance from intermediation to what people in the business call decentralized finance is the impact partly of monetary, first of all, technology. Things now are possible that used to be impossible. But the money-making incentives derived from that technology are the result of not just monetary policy, especially the ultra-low rates, but also the rules. The rules are asymmetric. Only banks are subject to stringent capital and liquidity requirements. So, of course, you can do a lot of things if you're Google or Facebook or Amazon, like all sorts of lending they're now doing to merchants and small businesses, their efforts to create new currencies. You can just be a lot more profitable than a bank, not just because you're smart and you have a lot of network effects, but because you're unregulated. That kind of makes it easier.
Okay, and we have a question from Denise Hearn. Some argue that the Fed is fundamentally incapable of meeting its mandates, given its historical and continued failure to stabilize the economy, quote unquote. Therefore, the Fed should be abandoned altogether. Do you see this ever happening, and how do you see the role of cryptocurrencies in promoting a movement away from controlled monetary policy by central banks?
Right now, I think cryptocurrencies are highly dangerous for any lower income, lower wealth person. Again, it's yield chasing that people putting into cryptocurrencies. They are not money. The money, again, chapter 9 in my book, I mean, money means a medium of exchange, not just overnight, but now and then for retirement 30 or 40 years from now, and it means a storehouse of value that permits that. And I do not think crypto or digital currencies have shown any capacity to be money. which means the more fiat currency vulnerable households put in cryptocurrency, the greater the risk they take. That doesn't mean that we shouldn't have digital currency. I really do think, again, technology is driving that forward. Do we need a world without central banks? We had one, and we in the 19th century, and it did not. I would like to first start with a much better central bank before making the call about whether we could do without any. We'd do better without any at all.
Okay, great. Thanks, Karen. And then we have one more question. There are a couple folks who already asked questions who asked second questions, but just again, to be fair to everybody, I'm going to go to everybody gets one question. From Yui Ueno, I hope I pronounced your name right. Assuming the Fed continues their policy along with the Treasury, it feels like yield curve control is an inevitable outcome because higher rates would be a disaster for both private and public sector. In that scenario, how can we try to mitigate the continuing transfer of wealth? Are there any ideas on how to tackle this without changing Fed policy directly?
Well, it's a great question. I think yield curve control just gets back to what I was trying to say was before. The Fed keeps fiddling with the knobs. I mean, yield curve control is essentially just another knob. Was okay, the things we're not doing that great at the short end. Let's go to the long end of the curve. Maybe we can fill there, and it'll be better, and then we'll have a better incentive for longer-term investment as opposed to shorter-term speculation. But the fundamental underlying dynamics are still going to be the same of a huge Fed portfolio. It's just going to be a different Fed portfolio, and I don't see why that would make any difference ultimately in asset allocation. It might change the maturity, but it's not going to change the extent to which long-term investment goes into productivity as opposed to financialization.
Okay, great. Looks like we have time for maybe one or two more questions.
Great.
Scott's asking a different question. Scott, I was going to ask your previous question.
Hi, Scott.
Isn't tax policy in the US, for example, our abhorrence of using graduated tax rates to help resolve income inequality gaps and the focus on cutting taxes for corporations and top wealth earners a big cause of income inequality in our country?
Yes, and I said at the outset, absolutely. I mean, we have a regressive tax policy, and it is a significant cause of inequality, but it is an incredibly difficult one also to reform, and that's one of the reasons I turned to financial policy. We could make a difference with different fiscal policy, not just in terms of taxation, but also transfer payments. But I wouldn't count on that. And I think, again, financial policy could be changed without an act of Congress. So that's one of the reasons I wrote the book. Not to say this is the only thing to do. It's just saying it's a thing that nobody has thought much about doing, and doing financial policy, making it more equal, would make a great big difference. Not to say should the only thing, but it certainly has to be an immediate thing to do.
All right. Well, it is 4 o'clock according to my phone. So I don't want to be presumptuous and take up people's additional time. We did have a couple of other questions. Maybe we can send them to you, Karen, and have them answered in the follow-up. And thank you all for joining, and we look forward to staying in touch. And thank you so much, Karen, for your great work and joining us today.
Thank you. Thank you both for your terrific questions. Thank you all for the hard ones at the end, and for your interest in, most importantly, in making things better through ESG and equitable investing. That makes a really big difference, and thank you all for that.
All right. Take care, everybody.
Thank you. Goodbye.
Bye-bye.